Good afternoon, everybody. Thank you very much for joining us this evening. My name is Chris Donovan. I am a sales associate at Lightspeed. And today we have a very special guest joining us. His name is Mark Schug. I believe if you've been with us for a while now, you may recall his presentations from last year. It's very informative, very helpful, and he will be taking us through today's webinar. We are going to open the floor up for a few questions if we have some time towards the end, and if Mark is kind enough to stick around as well. So we are slated here for a 4:30 start time, which is in about 2 minutes. So if you just sit tight, get yourself a glass of water or something, or a snack, and we will get the ball rolling here in 2 or 3 minutes. Okay, thank you very much, everybody. All right, so we're gonna go ahead and get started. So thanks again, everybody, for joining us this afternoon. Again, my name is Chris Donovan. I'm a sales associate here at Lightspeed, and today's a very special day. We have a guest. His name is Mark Schug, and he has been with us in the past, providing very, very insightful and informative presentations that contain a lot of relevant information to day trading. And so definitely, see what he has to say and reflect on how that may impact your trading. And before we get started here really quick as well, I just wanted to let you all know we're currently running a promo. It's the 10K 2021 promo for those of you interested in opening an account with us. You can apply for an account and use the promo code 10K 2021, and it will get you 50% off, 50% rebate of your equities and options commissions that you generate within the first 3 months of your account being opened. You do have to maintain a minimum of 25,000 in your account at all times during this 3-month period, however, so please do keep that in mind. And additionally, if you've not yet tried a demo of our platform, you can do so. You can request a demo. We'll send you a username and password to your email that you can use to log in to access the platform with. Just go to our website, lightspeed.com, and in the top right-hand corner here, you'll see a button that says try a demo. Just click on that, and it'll take you to the demo request page, and make sure you select the platform you'd like to try. And we'll send those credentials over to you. So you'll have access to that for 10 days. Additionally, if you're interested in opening an account with us, you may do so. There's a yellow button at the top. It says open account. Just click on that, and it'll take you to the first page and the first step in the application process. If you've been working with a member of the sales team other than myself, you can please, they would really appreciate it if you could list their name. So you can list them as the salesperson on your account, and they would be more than happy to assist you with any inquiries you have related to your account or the platform. You can reach out to us. Again, my name is Chris Donovan, so my name's at the bottom here. And with that being said, just got to read this quick disclosure here, and we'll be on our merry way. Okay, so this presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security, derivative, and futures trading involves a substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all of or more than your initial investment. Past performance is not indicative of future results. Lightspeed Financial Services Group LLC is not affiliated with these third-party market commentators, educators, or service providers. Data, information, and material content are provided for informational and educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis. Take into consideration your financial circumstances, investment objectives, and risk tolerance. Lightspeed Financial Services Group LLC does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, educators, or service providers, and any information used to execute any trading strategies are solely based on the independent analysis of the user. And with that being said, I'm going to shift over here the presentation to our guest, Mark. So just bear with me one moment while I give him screen sharing authority. So hang on just a second. All right, so there you go. Nice, yep. So we can see your screen, and you're coming through clearly on the audio. So please go ahead and take it away.
All right, great. Well, good evening, everybody. My name is Mark Schug. I'm an emeritus professor at the University of Wisconsin-Milwaukee. That means I don't work there anymore. I actually live in Florida. I'm retired from UW-Milwaukee, but I'm still reasonably active as a consultant, and very glad to be back with Chris and to be asked again to talk to the folks who are connected to Lightspeed. So thanks to Lightspeed for asking me back. So let's get on. It's been a busy day, folks. So we have a lot to talk about. And the way we do this is we're going to do a little recap of where things were in 21. I was at a holiday party the other night, and the guy was, oh, it was just awful. Oh my God, it couldn't be worse. And as calm down, man. Let's talk a little bit about what the economy did in 21, and then what's going to happen in 22, which is less predictable, of course, but I hope interesting. And what forces might hinder growth in 2022, and what might the markets do in 22. So that's sort of where we're headed. So how did we do? Well, first thing we look at typically is GDP. So we're talking about how did the economy do, not the markets themselves, and generally these track each other. But what about GDP, gross domestic product? Now, those of you that have been with me before, you know this, but just for if we have some new folks coming in, so GDP measures total consumption. It's done by the Bureau of Economic Analysis, and they're trying to measure total consumption. So that's consumer spending. Total investment in the economy, that's business spending and residential purchases. So, but it's mainly investment spending, and it's also home buying. But investment's really key because that's business spending, government spending, and then we do net exports, which means we count in GDP exports because that's stuff made in the United States, but we back out imports. That's the stuff we bring in, and typically that's been a negative number for a long time. So 2020, we were looking at nearly 21 trillion, and at the end of 21, we were looking a little north of 22 trillion. And so these are such massive numbers, it's just hard to even talk about. But so things look better in 21 than they looked in 20. So in the last quarter, GDP went up 2.1%. But in the second quarter, we saw a real bounce of 6.7. In this past quarter, there was a slight deceleration in consumer spending. That's called the personal consumption expenditures. That's measured also by the Bureau of Economic Analysis, and in residential investing, contributing to a little bit lower number, quite a bit lower number. And much of this was driven by COVID impacts from July to September. Remember, things have cooled off quite a bit since then, although we see some uptick now with the new variant. So estimates, we might end around 7.3%. 7.3% is a pretty big number in GDP, just about under any circumstances. But we know the circumstance here involves the recovery from the pandemic. So there you see the recent graph produced by the Bureau of Economic Analysis, and there you see the big 6.7%. That's really going to carry us through the year and make the GDP pretty strong. Employment seems to be moving in the right direction. So in November, we fell to 4.2. October was 4.6. And so, the kind of gold standard that we're looking for is 3.5. That's where we were at the pre-pandemic level, but it was a pretty amazing level at that time. So when we're getting down to 4.2, that's actually moving in a really good direction. Employment was somewhat disappointing in November. They expected a much higher number than 210,000. But the labor force participation number moved up slightly. So it edged up to 61.8 compared to 61.6 in October. And it's been in this very narrow, somewhat sluggish range between 61.4 and 61.8 since June of 2020. And so we're still off by about 1.5 percentage points. So this is the number of adults who are willing to work, have a job, or are looking for a job in the workforce. So in order to get the economy back to full capacity, we need to get people back in. And it's kind of interesting that why folks are not rushing back. The one big segment seems to be the 65-year-old and older crowd. those folks were actually coming back for whatever reason. They were coming back to work and rejoining the labor force, but I think COVID just scared them to death, and so they left in droves. And the other group tends to be young parents, and I think that many of these young parents, especially many of them are women, kind of reassessing, where their work and home balance is, and they've been not rushing back into the labor market. So it's interesting. We'll see if this changes. So I just put together these two graphs, and so you see the unemployment picture looks pretty remarkable. You see the big decline there, and then you can see here that employment has also been doing well. Payroll employment's been doing well. So you see from the massive drop, or in here unemployment, the massive increase, and in payroll, the massive drop. So those generally look good. We're going to come back to housing, but the National Association of Realtors says that existing home sales increased in October from the prior month, but sales were down somewhat because inventories can't keep up with the demand, and that's still being driven by low interest rates on mortgages and a large wave of home buying, which goes now back to the COVID-19 operation, keeping demand still pretty high. We're going to talk a bit about inflation. If sometime I'd like to come back and actually talk at greater length about it, but the consumer price index hit 6.8% in November. That's the highest we've seen in 40 years. There have to be a lot of people on this webinar that have never seen anything like that. Now, remember, I'm emeritus from my university, so I'm a little older than most of the people on this call. I have memories of when we were in double-digit inflation, and so this is not a lot of fun. But that's kind of where we are. But we'll come back and talk a lot more about this and see what might be happening in 22. Will the economy continue to grow in 22? Most economic forecasts are relatively upbeat, and so we'll look at a couple of them. We'll look at the Conference Board. They're saying GDP 5.5%. So we're still talking about GDP here, right? That's our measure for growth. Philadelphia Fed, a little less optimistic at 3.9%. And the Philadelphia Fed generally is a little more on the optimistic side. So this isn't exactly pessimistic. 3.9% still a really good number. Wells Fargo is saying 4.5. And we'll look at some numbers from the housing industry. Those are still pretty positive. And manufacturing continues to be positive as we're looking at 22. So, but the first thing is to remember, this forecasting stuff is very, very difficult. There are so many variables in the economy. You remember the housing collapse in 2007. Economists missed this thing totally. And so, that was real embarrassing for the forecasters out there. So let's be careful about this. There are a lot of things that could go wrong. I sometimes worry about confirmation bias because when you look at this, take a look here. See, everybody's, well, go back to that slide. See, everybody's pretty optimistic, right? So I sometimes wonder about confirmation bias, and everybody kind of moves in the right direction. So we have to remember things could go south fast, and to take these with a grain of salt. So let's just see. So Conference Board is one of the gold standard operations for doing forecasts. So if you come over to the 2022 column, there's a 3.5%. A very respectable number in GDP. If you look down at consumer spending, 3.3. So real consumer spending. So both these say real. That means they're adjusted for inflation. Okay. And then non-residential investment, that's business investment. And we want to see a positive number there because that's business spending. So that's businesses building new warehouses, expanding plants, hiring new workers, that kind of thing. So we'd like to see that as a positive number. Here's the Philadelphia Fed. Here they're saying 4.6% this quarter, 3.9% next quarter. They have this panel of forecasters. That's what they're all about. They have about 34, 36 forecasters that they survey, and their panel predicts real GDP will grow at an annual rate of 5.5 in 21 and 3.9 in 22. So that's down from some of their earlier predictions 3 months ago. I keep a close eye on this, and you can too. In 2 clicks, you can be looking at the Philadelphia Fed. Just put in Philadelphia Fed GDP prediction, and you'll be right there. And you can see how this updates. They're also feeling pretty good about unemployment. So they're looking at a pretty positive outcome there. They're saying unemployment will decrease to 3.9%. I just read now the Fed is saying about 4%. So that's a pretty good number. And in the fourth quarter of 2022, down to 3.7% in 24. So they generally see an improving employment picture. And here's our friends at Wells Fargo. Quick overview. They're seeing 4.5 in 22. They're seeing inflation at 4. They might be updating that. Now, this is their recent this is December. I rechecked all these before we got together here because of the Federal Reserve move today, just to see if anybody changed anything. But they haven't had time to absorb what's going on, and they're seeing unemployment at 3.6. So generally, pretty upbeat. So slower economic growth and lower but still elevated inflation will likely shape the outlook as the economy continues to grapple with shortages and lingering effects of the pandemic. So continued growth, and most of these forecasts are looking for inflation to continue pretty high, but to taper off by the end of the year. Okay, here's our National Association of Home Builders activity. So you can see from this graph, there a lot of homes being built nationally. Now I'm in South Florida, and I can tell you the home construction down here is almost insane. In my community here, they're building 7,000 new homes in the next year or two. So in some parts of the country, it's really amazing, and this suggests nationally it's going to continue as well. But housing is likely to cool some. So there was a report from Fannie Mae that median home prices are expected to rise between the fourth quarter and the fourth quarter of 22, our fourth quarter, and then the fourth quarter of 22. And that might mark a slowing from the extreme price growth we've seen this year. But we're still going to see strong growth by historical standards. Housing prices, Fannie Mae is kind of the Cinderella here, kind of in the middle. They're saying prices at 7.9%. Zillow for 22 is saying 13.6%, and Goldman is way out there at 16%. So, so it looks like home prices are going to continue to go up. So you might be keeping an eye on. There are so many facets to the home industry. There's so many things that go into home construction. From roads to carpets to lumber, concrete, windows, glass, all that stuff. So, this sector doing well is real important to the economy. And finally, I like to look to the Institute. Oh, I got one more after this. I like to look to the Institute for Supply Management. They are routinely quoted in credible places like the Wall Street Journal on their manufacturing. And here is their very latest manufacturing prediction. So they're saying November is 61.1%, up just a tick from October. But again, anything over 50 is regarded as strong. And so here's how they're looking at things. They're generally pretty upbeat on the manufacturing side, seeing the direction of the overall economy is growing and the manufacturing sector as well. So you might keep an eye on those firms in the manufacturing sector to see what's happening there. So that's again a pretty optimistic outlook. I love this economic policy uncertainty index. This index is calculated by actually looking at the media and looking at gloomy forecasts out there. People, what are the writers, the business writers, saying out there about what is happening in terms of policies? And they look at a variety of very specific things. In addition to that, it shows just a little uptick in the last couple months. And generally, economic uncertainty is associated with the declining stock market. Generally, the markets don't like surprises. And so, a declining economic uncertainty index is good news. An increasing in uncertainty index is bad news. And you can see there's just a little uptick here. So overall, the pattern is down from where we were. I apologize, folks. My dog has seen somebody outside, so somebody had the audacity to walk by the house. So I apologize. My wife's gonna get him quieted down. So that'd be a little reason to worry why this uptick. I'm guessing it has to do with what's going on in Congress. You're welcome to have your own guess, but the Build Back Better legislation has gone through so many iterations, and the tax packages keep changing. That I got to think that the tax proposals keep changing. That might be lending something to this uncertainty index. All right, so where are we going to go? What are forces pointing to slow growth in 2022? Well, just a quick overview. I'll dig into these. Certainly COVID uncertainties, right? So we don't know. We have this new variant. It doesn't appear to be the end of the world, and the markets have recovered quite a bit. But still, we're getting trained to the idea that things can happen out there. I'm not going to talk about Iran, Ukraine, and Taiwan. I just want to lay it out there that if Iran goes ahead with its nuclear program, if Russia would attack Ukraine, if China would attack Taiwan, markets don't like this stuff, right? And so that piles in a lot of uncertainty. A place like Taiwan is a very, very important economy in the world, does a lot of international trade, a lot of chip manufacturing. So I'm not going to dwell on that. I mean, I'm certainly no expert in geopolitical things, but just to get that on your radar, to be thinking about that a little bit. The inflation is the one we're going to talk about, and we're going to talk about monetary policy and why, if monetary policy is going in the wrong direction, why we might actually be in a fix where investment might be crowded out in the future. So generally, the stocks don't like new COVID variants. So this is the Black Friday slide of what happened on the markets when the new variant arrived. And so that's just a reminder that things can change. Now, of course, they've come back quite a bit since then. But that Black Friday thing, I had a lot of friends that sold on that. Me personally, and we're not endorsing anything here. You've heard the disclaimers from Chris. Me, I'm buying, right? So I had a friend who sold off. I told my friend I did just the opposite. So just a thought out there. So the CPI, what's going on with the Consumer Price Index? Now, what is this anyway? What is inflation? So the inflation. The CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. So if the price of used cars go up, that's not inflation. If the price of lettuce goes up, that's not inflation. It's an overall increase in prices. So we have a very fluid economy. Supply and demand drives the vast majority of prices. So if energy prices are up and then they're down, this is largely a supply and demand thing. And we expect energy prices and food prices to be volatile. So just an increase in lettuce doesn't mean we have inflation. The classic definition of inflation is too much money out roaring around in the economy from consumers, from businesses, and from government and from the Federal Reserve chasing too few goods. And that's what's likely, that is what would cause inflation. So just a word or two. The Consumer Price Index is compiled by the Bureau of Labor Statistics. There are other measures of inflation. The consumption index, personal consumption index, is what the Fed tends to use. But this is the personal consumption index. It comes from the Bureau of Economic Analysis, and that's actual GDP spending by consumers. The trouble with that number is it lags by about a month behind the CPI. But the CPI is what everybody talks about. The CPI is really important because this is where inflation can get baked in, is that Social Security increases. There's a COLA, cost of living increase for Social Security. That's driven by the CPI, not by the personal consumption index, that the other number the Fed uses. So when the CPI is up, so suddenly all the people getting Social Security, and that's millions of people, suddenly they get a raise. And so what do we have? We've got more spending. A lot of union contracts are hooked to the CPI. So boom, their wages go up. So it's kind of, once this genie gets out of the bottle, it's a little hard to bring it all back. So the CPI is based on a price index of a market basket of 300 items. This is what it looks like. So the Bureau of Labor Statistics sets up based on research and data, but it's a theoretical market basket. And you see there, housing, wouldn't you expect housing to be the dominant thing people spend money on? Of course. So that's 41%. That's that blue part of the pie there. And then we've got transportation at 17%, and we've got housing at 15%. This probably matches up with your situation. But notice it doesn't match up with mine. My house is paid for. I don't have a mortgage. So this doesn't reflect my spending. If I'm a college kid living in a dorm, my parents are paying for the dorm. It doesn't reflect their spending. So you see, that's kind of one of the issues here, is it's sort of this market basket that is put together. And there's other problems with it, but we're not going to deal with that. So this is the headline going on right now. US inflation hit a 39-year high in November. Prices rose 0.8% in the month and 6.8% year to date. So that's a chunk, okay? And the Bureau of Labor Statistics is saying the strong consumer demand collided with pandemic-related supply constraints. So they're arguing that it's the pandemic that is driving this big jump. And then, of course, the really bad thing is that, while the employment numbers look good, and we haven't had a slide on it, but the wage numbers look good too. Wages are increasing, and that's certainly no secret. But when you get inflation like this, it gobbles up those wage benefits. And so we get into this cycle, right? And that's really what makes this part of the problem, at least. And then today, just today, the producer price index. So this is the measure also done by the Bureau of Economic Analysis. This comes out of the Labor Department. And so this is wholesale prices, called the producer price index. So this is up 9.6%. We have never seen that big a jump in the producer price index. So that's a problem. Now, these are wholesale prices. So these are prices that are now going to be working their way through the economy. And the two graphs you see there, the dark blue line, that's total PPI. But the lighter kind of gray looking thing, that backs out food and energy, which tend to be more volatile. But nonetheless, this suggests that inflation is really baked into the operation here. What if inflation is not being driven? I'm not sure why I've got the thing there. We'll get rid of that. What if inflation is not being driven solely by supply chain disruptions? What if inflation is also being driven by fiscal policy and monetary policy? Everyone's saying supply chain. Well, no one's denying that supply chain is part of it. But Milton Friedman would point out. Now, Milton Friedman, you may or may not know, he won the Nobel Prize in economics. He passed away a few years ago. I think it was 2006. But he has been regarded for decades as the expert on monetary policy. And he writes this: inflation is always and everywhere. I get that. You got that? Look at how strong the statement this is. When do you hear economists make this strong a claim, or anybody? Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So the quantity of money rushing into the economy is increasing faster than, so we say we're going to end the year around 7%. So the claim here is that the amount of money being pushed into the economy is much higher than GDP, outpacing GDP, which is output in his definition here. And that's what's causing inflation. So what's behind that? Well, we put 6 trillion into the economy in response to the pandemic. Now, just about everybody I know, economists agree that we needed to do that. But that was 25% of GDP. So that's a chunk of, right? We're only around 22,000 GDP. And then now we're still in the pandemic, right? So in March of 2020, we passed the CARES Act. We're still in 2020. We do the payroll protection program, which saved many businesses and many nonprofits. That was about 500 billion. And we're still in 2020, and we did the Consolidated Appropriations Act. Fine. But now questions might be, what about the American Rescue Plan? We're now in 21. We have the vaccinations and so forth. So that's 1.9 trill. That's another 2 trill going into the economy. And then we tacked on top of that the 1.2 trillion infrastructure. Now, not all of that was new spending. About 550 billion was going to be new spending. And then we're talking about the 2 trillion Build Back Better bill. And the office for the Congressional Budget Office reported out to Congress, and of course it was in the media, that it's actually much higher because many of these programs are set to expire after 3 years. The taxes go out for 10, but many of the programs only go for 3. And I think most adults would say those programs you're not going to just pull those benefits from families and pull those benefits from seniors, that those programs are likely to continue. So this is more like a $4 trillion package. So that's a lot. Now, so this is, please understand, this is not a political statement or anything. It is, however, a timing statement. When we are seeing this kind of inflation, is this the right time to be doing this kind of thing, or will it make it worse? So that's the fiscal policy side. What about the monetary policy side? Well, we know that the Fed has been keeping interest rates very low. And of course, why doing that? Because they want to encourage banks to lend money to businesses and consumers so that they will spend more and keep that consumption spending and business spending back in GDP high. And so you see where my little arrow shows you can't go any lower than where the federal funds rate is today. The federal funds rate is the rate upon which all the other rates are built. So I think of it as this is sort of the cost of money to a bank. And so that's sort of the minimum. And then above that stacks home mortgages and personal loans, car loans, credit cards, and all that sort of thing. So this is a very important number, and the Fed actually can control this number much more carefully than much more directly, I should say, than it has in the past. So it's kept interest rates low. So the question I'm leading up to, did they keep interest rates too low for too long? And then they've been doing the quantitative easing. The quantitative easing means that they've been buying $80 billion in treasuries. So those are US securities, and 40 billion in mortgage-backed securities each month. So that adds 120 billion into the economy every month. Now, when they buy treasuries, they're not buying them from the US Treasury. That's illegal. What they are doing is they're buying them from financial institutions like Goldman Sachs. So Sachs buys them, and then the Fed buys them, and you see on my graph here, tucks them away on their balance sheet. And you see that rise in the balance sheet. Now, we've never been in a position like this. This is $8 trillion on the Federal Reserve balance sheet. And what does that mean? Well, what this means is the money that the Fed is using to buy treasuries, let's say, and mortgage-backed securities, that money goes out to the financial institutions like the Goldman Sachs, like Wells Fargo. What do they do with the money? Well, of course, they push it out into the economy. That's the whole idea, right? So we have low interest rates pushing money out into the economy, one part of the Fed monetary policy, and then we've got quantitative easing pushing money out into the economy. And this is what we call monetizing the US debt. So we're taking the debt we're shoving it away it's represented by those bonds that are on, in fact, the balance sheet, but we're monetizing it and getting those funds out into the banking system. And this does all kinds of stimulative work, including pumping up stock markets and housing markets and stock markets, housing markets as well as stock markets. So have we seen an overreaction? I think now the evidence is in, because I'll show you a couple of slides here that I updated just a couple hours ago. Is it plausible that the Fed, Congress, and two presidents overreacted to the pandemic and induced the highest inflation we've experienced in decades? Maybe the Fed needed to move sooner. And in that sense, then they overreacted, and maybe Congress, their timing hasn't been so great lately. So this is the news just a few minutes ago. Fed officials project 3 rate increases next year, and they're going to accelerate their winding down of the quantitative easing. So they're going to cut it down by several billion every month, the quantitative easing part. So just for your information, the entity that made this announcement is called the Federal Open Market Committee. All right, the FOMC. You probably think that's the Fed. It's just a subcommittee of the Fed. It's made up of the Federal Reserve Board and 5 of the regional presidents. And the president of the New York Fed is always on this particular committee. So the FOMC is the entity today that released the press release that said that it's going to cut back its quantitative easing by March, and it's going to start raising interest rates 3 times in 22. Now, the article I read, I couldn't see when in 22. So I don't think they're telling us that yet. So the question is it going to be first quarter, second quarter, third quarter? They're going to wait till the second half of the year? So far, I haven't seen it yet. Maybe some of you have. And when we get to the chat, maybe, or if you have questions, maybe somebody knows. And so we're seeing 3 more increases in 23 and 2 more in 24. So the Fed has clearly and somewhat maybe abruptly is changing direction, but the markets responded positively today. So they first started to dip a little, and now the last time I looked, they're actually going up pretty dramatically. Let me see if I can see real quick. Yeah, Dow is at 35, almost 36. S&P is at 4,700. So those indexes are both up. And so it looks like there is more worry about inflation out there than I think a lot of people thought. Now, what's the worry here? Okay, now if we're starting to correct for inflation, that's great. But one of the ways, so let's take a look at the debt now. So the fiscal policy end is what has stimulated this debt, right? All the spending for the pandemic and all the spending that we've been doing now in 21. So here's the projection out here. This is the CBO, Congressional Budget Office. This is an entity of Congress, right? This is a nonpartisan operation, and they're predicting GDP of close to 200% of that. Our debt would be close to 200% of GDP. That's an amazing, an unheard of number. I mean, compare it down to World War II. All right, so this is scary heights here. All right. And what makes it so scary? Well, part of what makes it scary is this number right down here is interest. So the Fed's starting to raise interest rates. So now when new bonds are being sold, those interest rates are going to have to go up. And that's going to have multiple effects. One thing we worry about in terms of long-term growth in GDP is that you're Goldman Sachs, and here's your opportunity. You get to invest in the private sector, invest billions in Amazon and so forth, and whoever your clients you're looking at, and risk, that you've done a good job measuring their profitability and so forth. Or why don't we just buy a few federal bonds and lock them up? And we know the federal government, we know Treasury is going to pay these off. So you see what I'm saying is that once interest rates start to rise now, then the private sector starts buying more federal bonds and doing less investment in the private sector. That's bad news for investors. That's bad news for all of us. That means that the number of jobs in the private sector won't grow as fast. It means productivity gains are not going to grow as fast. And then the second big issue here, so we call that the crowding out effect. You're crowding out private investment because government bonds are competing with it. And the second thing is Congress. This really pushes Congress up against the wall. Most of their budget already goes to Social Security, Medicare. Over half of their budget already goes for entitlement spending. So that's by law, locked in. Okay, so they can't do anything about that. And then they have to pay the interest on the debt, and you see what's going on there in my blue shading. So they have to do that. They can't default on bonds. So it keeps crimping what the federal government can do at all. So for the military, for police, for education, for infrastructure, for all that stuff gets squeezed and squeezed and squeezed. So that's why these levels of debt are painful, okay, or at least potentially painful, maybe we should say. All right, let's start to wrap this up now. How might the markets do in the second half of 21? Well, let's look. Actually, that's a mistake. How should the markets look in 22? Sorry, I didn't catch that. So this is how the market's going to look in 22. So first, nobody knows, right? Just to be clear, all of our friends at Lightspeed, all of our friends at the Federal Reserve, all of our friends at the Congressional Budget Office, they don't know what's going to happen with stocks. So, right, so that doesn't stop Wall Street analysts and others from issuing their projections, but it's true, nobody knows for sure. So what do the Wall Street Journal, what do the analysts say? Well, Morgan Stanley says S&P is going to be down. Now, today it was 4,660, and I think I just saw it's now above that. Wells Fargo is more optimistic on stocks. Goldman Sachs, a little more optimistic. And the Royal Bank of Canada, about the same. So Morgan Stanley is a little negative. The other three are a little more positive. Morgan Stanley's real skeptical on U.S. stocks and bonds, and they say Europe and Japan might be a better place to go. So maybe you want to be looking at a little bit some international opportunities. So you might just Google up Morgan Stanley's strategy team and see if they're updating things. That's the other thing, is that given today's news, some of this might change. And why are they saying this? Well, fading monetary support. What does that mean? That means that the Federal Reserve is going to change policy, and they're right about that. They have changed. They've already announced the changes. Fading monetary support probably also refers to fiscal spending as well, and high valuations. I mean, we're at pretty high levels in terms of American, in terms of our stock markets, beginning in 22 here. So that's what they're saying, even though they expect economic growth to improve and inflation to moderate. Goldman Sachs, I just double checked all this. They were saying that the Fed was going to act sooner, and so it turns out that they were right. The U.S. economy largely followed the rapid road to recovery as we expected this year, and is on track to round out the recovery next year in 22, as most of the remaining effects of the pandemic fade. They are worried about inflation, and they're saying, in this is before today's announcement, that the Fed is likely to raise interest rates in July. I think the way we'd read this announcement is it'll be sooner than July. So that's what Goldman Sachs was saying. So if high inflation is prolonged, which it seems like it's going to be in 22, despite these actions being taken by the Fed, investors typically seek shelter in things like Treasury inflation protected securities, or TIPS. That might be a hedge to look to. Investors often look to things like gold and other commodities. Some investors just stay in stocks because that's historically where you get the better return. So that's your hedge against inflation, and others might move to more defensive stocks, such as utilities. So that's sort of where we are. Let's go over this one more time. So the economy did pretty well in 2021. We started to see the uptick in inflation, but GDP and employment numbers were all moving in the right directions. most of the nearly all the forecasters, Goldman was a little more glum, were saying that good things are going to happen in 22, but overall things are slower. Both the stock markets and the economy itself are likely not to be expanding as fast as possible. Now, just to hold on there, if the Fed starts to raise interest rates very aggressively, and it's going to be ending its quantitative easing, the risk they're running is that they could tip us into a recession where GDP is actually turning negative. So I don't envy Jerome Powell and his colleagues in trying to know where these numbers should be. I think they're probably going to move very, very gradually. Maybe increasing things 25% of a basis, 25% of a basis point going forward. Which each one of these is a real gradual uptick. But if they overshoot, it's conceivable that you could wind up with what we haven't had since the 1970s, which is stagflation, that we could be steering ourselves to negative economic growth while we still have inflation. Something to worry about is a lot of the forecasters are all saying this has to do with supply chain issues. Supply chain issues. Does raising interest rates affect supply chain issues? I mean, how does raising interest rates help unload a boat off Long Beach, right? So we're holding, so just a little caution. All right, housing manufacturing looks strong, and that's for sure. The policy uncertainty index is increasing, but only a little bit. And one big fear, of course, is that's really just a loose cannon out there with the new COVID outbreak. We saw how the markets responded very, very negatively on Black Friday, but we also saw they came back. Another fear is inflation, of course, and how the markets are really going to react to this change in monetary policy. And then another fear, a little longer term, is this debt crowding out private investment, and that might result in some issues. So overall, they see the markets slowing in 22, but I think there's still a lot of opportunities out there. So that's where we are. Oh, that was a lot to say here, and there's a lot of action going on, but I think I'm going to stop showing my screen. Well, let me see. Chris, you want to see if there's some questions out there?
Sure. Yeah. So I don't see any questions currently in the chat, but if anybody does have questions that they would like Mark to address, you can certainly go ahead and ask now, and he'll address that for you before we wrap things up.
All right, so I'm hitting stop share. Yeah, and okay, it doesn't seem to want to stop sharing, but that's okay. Someone might have a question.
Yeah, no, that's okay. So if anyone has any questions, we will leave the floor open for a few minutes here, so Mark can address that for you before we end the webinar for everybody. So I do have one question here coming in from Naveed. He was asking how the inflation would affect penny stocks. I'm not sure if you have something you could say with regard to that, Mark.
Well, penny stocks are just, tend to be pretty volatile themselves. So I think I'd have to know more about which company we're talking about to really know how inflation might affect it. I don't know that inflation would drive a whole sector of penny stocks one way or the other. So it's a good question. But I think
okay.
you'd have to dig in a little deeper into the sector you're talking about.
Sure. Yeah, that absolutely makes sense. Did anybody have any questions? We do have a few more minutes before wrapping things up. So let's see here. Rob would like to know, is there a concrete relationship between inflation and volatility, or can it vary?
No, I think there would be a good relationship. Inflation is a contributor to volatility, in the sense that it raises uncertainty, and depending on how it's being played out in the various sectors and whatnot, That's certainly relevant. But yeah, I mean, this just makes life difficult, right? It's hard to know what kind of smart decisions to make when prices are increasing so dramatically. And and that would be a case for getting defensive. If you're really worried about it, to start to get defensive. Uh, so right now, I'm kind of glad to see the Fed has. You're just kind of. I'm glad the Fed's moving, changing its. It obviously has changed its mind, and it actually sort of admitted that it did not recognize the inflation for what it was. The Fed is not a very humble institution, so that all by itself is kind of remarkable. But then you worried, are they going to overreact and then push us into a very difficult direction? Where stock markets are down, unemployment is up, and inflation is up. Boy, we don't want to be there. That's where we were in the end of the 70s. And then it took an enormously painful recession induced by the Fed. Paul Volcker, who you may have heard of, was the chairman of the Federal Reserve back, I think he was appointed in 1978 by the Carter administration. And he raised interest rates through the roof and induced a massive recession. Housing collapsed. I'm just hopeful we're not going to see any of that. That if the Fed reacts, if this starts to come under control, and the first indications are the market is very positive, then we should see a little decrease in that volatility out there.
Nice. Okay, thank you for addressing that. So I think you touched on a few points here already, but Lindsay had a question. She says it seems scary that inflation is going so high so quick. Why is the Fed not doing something sooner? Or what else do you think they will do in first quarter? And why did inflation not go up in the last 4 to 5 years?
Yeah, well, the monetary policy was fairly modest during this. We didn't start the quantitative easing and the drop in interest rates until 2020. So that was the Fed hitting the switch. Uh, and of course, they were terrified. We were all terrified in March of 2020. So the Fed was going to do its part to make sure that the economy didn't collapse. So it has two main levers. It can lower or raise interest rates, and they lowered them dramatically. You saw the chart back there. And they went to a pretty aggressive quantitative easing. So now the question is, did they keep doing that for too long? And so they ignited this inflation. So I think that's, so you see what we're making a much more nuanced argument. We're saying it's not just supply chain things. We're saying the Federal Reserve is complicit here in having been very aggressive with the pandemic, but then stayed with its aggressive policies for too long, thus really kicking up inflation. And now they're reversing course. Congress did something very similar by passing a lot of the spending in 2020 that most economists would regard as extremely helpful to keep us from collapsing. It was a government-induced collapse, so it would seem to make sense the government would do something to correct it. But again, the continued spending into 21 is a little harder. Again, over the long run, we like infrastructure investing. It tends to produce productivity gains and that kind of thing. But the question is, was this the right time to do it? I mean, this is a very unique period that we're coming out of. I hope I'm answering your question here. So we're concerned that the Fed did not act soon enough, and they kept their foot on the gas pedal in terms of monetary policy too long, and they should have been easing up, at least 2, 3, 4 quarters ago. I mean, in 21, we've been back pretty strong. So early in 21, they could have eased, and here we are at the end of 21, and they just kept their foot on the gas pedal that whole time.
All right, awesome. Thank you for addressing that. So we've got another question here from Jose. He's asking, will inflation drive down the stock price of tech and marijuana stocks?
That's a great question. I'm wondering if I hesitate to say they're immune, but I wonder if even if those prices tick up a little, that people would still want to do their purchases there. So you check me on this. I predict that sector might actually weather the inflation. That's back to this other thing on the penny stocks. You kind of have to know what sector we're talking about. So I'd say the marijuana industry might, the legal marijuana industry might continue to do reasonably well during this. I wonder if that even could be regarded as a defensive stock. That's a great question.
Yeah, I guess we'll just have to see how it shakes out. All right, so I think we'll take one or two more questions here,
Okay.
and then we can wrap things up. So if we got a question here from Mike, he is saying, what impact, if any, will the rise of the crypto market have in the equities market moving forward, with some folks seeking shelter from inflation in those markets? Along with debt crowding out private investment, will that be compounded with money moving to crypto?
I think that's a really nice question. The crypto thing, we talked earlier about volatility. That continues to be a very volatile operation. But I kind of like your hypothesis that if where are you going to go for a return? Where are you going to go for gains? And so that the more high risk investors might, consider the cryptocurrencies as a place to go to get away from, to protect them from inflation and get bigger returns. This whole industry is still, unfolding. Uh, I don't know. It'd be fun to just talk about it sometimes. I don't pretend to be an expert on crypto, uh, but from what but of course we all know it's a very volatile sector, and it would be more for the people that are willing to handle the risk. And I'm guessing a lot of our listeners here, or a lot of our viewers, are in that category. But so yeah, I think you could make a case that would be a place where you could get some return. But do it carefully, because it is still a very high risk sort of investment.
All right, great. Well, I think we can wrap things up here, Mark. There don't appear to be any new questions coming in. So thank you once again for joining us, everybody, and Mark. Thank you very much. We are happy to have you on as a guest once more. We wish everybody happy holidays and a happy New Year. Stay safe and healthy, and thank you again for your time, Mark.
Thank you, Chris, and thanks for everybody for coming and being with us this afternoon.
Take care, everybody.